Well, it was a bloodbath on D Street today, extending losses for the third straight day. The Indian markets fell over 2% in today's session. Nifty ended 1.9% lower to close below the 17,600 mark, while Sensex tanked over 1,000 points, its biggest drop in 3 months. Most sectoral indices declined this week, with Nifty IT turning out to be the worst performing index for the week. Anisha Jain is here with a roundup of all the market action.
Well, it was a topsy-turvy ride for the Indian markets this week. We hit a fresh record high when it comes to the Nifty Bank, and that was the clear outperformer this week because for the last 4 weeks, that index has been inching higher, and this week as well, Bank Nifty eked a gain of around 1%. Having said that, Nifty declined for 3 out of the 5 sessions, and as a result, for the entire week, we have seen a cut of 1.7%, and that's the biggest cut that we have seen since June of 2022. Most of the sectors were actually in the red, but what really led to the fall of the market was the IT pack. The IT index was down about 7%, and to add to that, even the media space was coming under quite a bit of pressure. What actually bucked the trend surprisingly this week was the metals pack. So we saw the metals pack advancing for 2 weeks in a row, and stocks like Vedanta, Adani Enterprises, etc. were some of your top gainers. Separately, beneath the surface, a lot of sectors were in focus this week. Cement, of course, was in focus on account of the entire buzz regarding M&A and consolidation. There were a lot of tire names which are also catching up after the big rally that we have seen in the auto names. And defense remains that special pack which continues to get a lot of buying interest, not only from the DIIs but FIIs as well. And overall, the market experts do believe that going forward, while the undercurrent is still strong, maybe ahead of that Fed policy event lined up in the coming week, we'll continue to consolidate around that 17,500 mark.
All right, so what can we expect next week from the Indian market? Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund, is with us on the show. Sunil, hi, great to have you on the India development debate. Do you see the pressure of global markets and fears of a global recession now beginning to impact the euphoria we've seen in the Indian markets? For the last few weeks, India has been on its own trajectory, looking at largely domestic factors and how relatively we're doing better. But is that global fear catching up?
Not really. So let me explain what do I mean. I don't think that the recessionary fears are what are affecting the Indian markets. I think it's the fear of money going into safe haven US dollar as a higher interest rates come through that is leading to the reaction in the markets. A recession in the advanced economies is actually good news for India. Why? Because of the fact that in a recessionary scenario, oil and other commodity prices will be expected to come down, and which for a commodity importing, oil importing country like India is actually good, all from the perspective of our trade deficit and fiscal deficit, our domestic inflation, our corporate sector, those companies which rely on oil and imported commodity related derivatives for their inputs, their margin pressure easing, as well as pressure on the currency easing because your import bill will come down. So a recession in the advanced economies, I think is good for Indian economy, except for the fact that exports, whether it's IT or it's pharma or any other exports, will get affected in a recession. So the impact on the economy in terms of GDP will be to the extent of the export sector getting impacted, but there's a whole host of benefits of lower commodity prices. So the markets are not reacting to this recession as much as to the fact that short-term economic data in the US is coming in better than expected. And hence, a rate hike would be higher than originally programmed. And that higher interest rate would mean two things: equity to debt reallocation in capital. Second, within the markets, from emerging market to US, because of better interest rates in a risk-free country like US is a magnet for flows. So I think that's the way I would read it. So to me, if you then take the recession story forward, right, I would say that that will actually then translate into a reversal of FPI flows in the medium term. But we'll discuss that in your next question.
Let me get Dilip Bhat also in. Dilip Bhat, joint MD Prabhudas Lilladher, also with us this evening. Dilip, great to have you on the show. Just, wanted your take and your outlook of what we've been seeing in the Indian markets. And that's the point I made to Sunil at the outset. We've been sort of on our own track while the rest of the world has seen worries about higher interest rates, about possibly a global recession. We've seen FedEx statements and how it's spooked, Wall Street today. They're very clearly saying they're going to revise their guidance because they see growth slowing down. And that's a fairly decent indicator. Can we remain immune to that?
Well, I think there are too many moving parts in this. And without any doubt, the global headwinds are definitely going to have its impact. But the way the FIs have come back into the Indian market gives some kind of hope that maybe this decoupling theory with the other emerging markets that will play out well. But I think some of this, in my opinion, still remains a little more of a wishful thinking. So we have a very schizophrenic kind of scenario playing out right now, whereas the market continues to have a very bullish outlook. Some of the challenges, whether domestic or global, continues to haunt the markets and the economy in a big way. So my own sense is that the kind of apprehensions which is there in the market will certainly is here to stay. Markets may cross previous high and so possibly could consolidate around those levels. Downside appears a little limited from the current levels, but yes, the volatility that we are seeing can see the markets rocking both the ways, up and down. And that is where one needs to be a lot more cautious. Maybe in the long term it's good, but short term, I think it will still remain extremely volatile and a little more unpredictable.
Mr. Bhat, I think the story of the last couple of years is how, of course, the participation of foreign investors continues to be crucial, etc., etc. But how domestic investors have really come in and put their faith, I would say, in equities in a way which they haven't before. Do you see that as a game changer as far as the exposure and the impact of global factors on Indian markets?
Well, absolutely. I think you have hit the nail very rightly on the head. I think, yes, the number of demat accounts itself speaks volume about the fact that the retail investors have come back. And that is where I was just trying to say that the downside appears to be limited. And that is where I was coming from, that the retail investor participation has ensured that the absorption by them of whatever the FIs had to sell has been done very well. Now, that itself is good, as well as a kind of a small issue over there, because when a retail investor absorbs it, it is not necessarily that they are very long-term players. They possibly would come in to sell. So when an institution sells and a retail buys, so the retail investor will certainly come at a slightly higher level to sell. So those things will continue at the moment. And the only difference is that retail investor is not a real long-term investor. And at the same time, they give a good support to the kind of selling that we have witnessed. And markets are better placed to absorb the selling pressures as compared to the earlier times.
Sunil, let me come to you on the point of the choppiness or the volatility we're likely to see in the short term. And is that something investors will have to brace themselves for? Sunil, that question's for you. Yes.
Yeah. So I think, yes, short-term volatility, because every day there's news flow around various economic data from the US. There's a second guessing of the Fed, what they will do. Jackson Hole was a big turning point in terms of the clarity from the Fed that inflation is far more important than growth. I think that message came through very clearly. The second aspect is that I think that this there is a big I think volatility coming from the stronger the short-term economic data, the greater the fear that inflation from the demand side will not cool down, and the greater the pressure on the Fed to hike interest rates to kill demand. So it's a slightly contrary. The better the news in the short term, the more Fed rate hikes will be higher and the more short-term volatility will be there. Whereas if growth slows down in the short term, you will find the Fed easing up, saying, hey, growth is slowing down. I don't need to act so tough on inflation because demand by itself is coming down. So it's a very interesting play between short-term growth and long-term growth, which is why the volatility is going to be quite high. But to me, ultimately, for a long-term investor, this is a good buy on dips with the provision that focus on domestic, because it's the international recession which could impact export sector. So stay cautious on exports, but on domestic growth, I don't see it being big. The decoupling that we speak about is that Indian economy, barring exports and barring the imports, is decoupled from its growth because the government's capex drive, private sector capex revival, consumer discretionary revival, all these are pretty robust stories. So I would say that 60 to 70% of the Indian economy is decoupled. The recessionary forces will hurt exports, but will help our imports, substitution, whatever we are getting in terms of lower oil prices are beneficial for Indian corporates. So it's a very, very interesting time to play. And I would strongly say that with a 3 to 5 year outlook, domestic oriented sectors, any correction is an excellent buy on dip kind of signal.
You just keep a heart of steel as all of the day-to-day volatility comes in. Well, on that note, thank you so much, Dilip Bhat and Sunil Subramaniam, for joining us on this Friday evening to talk markets after what has been a hectic week. You'll have earned yourself a great weekend. So thanks once again for speaking with us today.
Thank you so much.